If you have a FHA or a VA loan on your home might be worth more when you try to sell in this market. This is because FHA loans and VA loans are what are called assumable loans. Basically, what this means is that the person that buys your home can take over the loan and the mortgage payment. This might make sense to them if the interest rate on your loan is really low, which means the monthly payment for them would be really low. For example, if you have an $800,000 home with a $650,000 loan balance, which is at 3% interest rate, a buyer can take over the loan and keep that 3% interest rates. By doing so, their monthly payment, instead of being $5,300 a month at 6.5% interest rate, will be $3,900 a month at 3% interest rates, which means they're saving $1,400 a month, which translates to about $17,000 in a year. Even if they pay extra $100,000 for your property at that 3% interest rate, the monthly payments for them is still going to be lower than purchasing an $800,000 home at a 6.5% interest rate, which is about the current market rate right now. Now, the buyers had to come up with the difference between the purchase price and the loan amount. So for the previous example of the house with $800,000 and a $650,000 loan balance, the buyers would have to come up with the $150,000. As you can imagine, this will limit the number of buyers that could take advantage of the assumable loans, because not many buyers have $150,000 saved up. There are ways the buyers might be able to finance that $150,000 if they don't have it. They could take a second mortgage, or it might make sense for you to do a seller carryback. There are some extra steps you need to go through to get this done, but your realtor should be able to help you with that. For example, the buyers had to get approved through your lender because they're taking over your loan. If you have a FHA loan, it's less complicated. You might have to do a longer escrow, maybe about a 45-day escrow. If you have a VA loan, you can let someone assume the loan even if they're not a veteran, but it's much easier if they are a veteran. If you let someone that's not a veteran assume your VA loan, this will mean that you won't be able to buy with 0% down till the buyer pays off that mortgage, which at a 3% interest rate, they might hold on to it for the life of that loan. However, if you're not planning on using the VA loan in the future or using that 0% down program, it might make sense for you to give it up, but you really have to consider if it's worth giving up that ability to buy a home with 0% down. To summarize, if your home has a VA or a FHA loan, it might be worth more in this market if it has a low interest rates, because those loans are assumable. The smaller the difference between the purchase price and the loan balance, more buyers will be able to use the assumable loan because they had to come up with the difference as down payment. If you're in Southern California, you need a realtor that knows how to work with assumable loans, you can reach me at my number here. If you're outside of California, you can still reach out to me. I can get you connected with an agent that knows how to work with assumable loans in your area. I'll also put my info in the description below. I hope you found this useful. Subscribe for more real estate tips. I'll catch you later.